2023, we had a great year where we introduced new equity offerings to our investors. The reason we did this was a lot of our investors have been growing with us for the last few years, and they've asked for opportunities where there's different tax benefits or ownership benefits to them rather than just investing in a fund and getting some sort of return. So this past year we brought on over a dozen different ground up opportunities where investors could invest directly in them and own them, right? So there were smaller ones, not these bigger properties, bigger, 200-300 unit buildings that we've done in the past. These were small deals where we're buying a piece of land. We have the investor come in directly, purchase that, own it, we'd work it, and everyone would make some sort of percentage on it. We successfully closed them on both ends where we've purchased, built, sold, or refinanced, and made the investors good returns. We have a lot of those under development right now, and we have a great pipeline coming along for new opportunities. Their benefit is, one, they're getting in at the ground level, literally. After that, they're getting the most value, and then we're adding all the value onto that piece of property for them and running that property and the management and the day-to-day with our partners and operators. Additionally, we've also been investing in stabilized assets, single ones, right? So an investor comes in and they want to buy something that's stabilized, and it could be a 30, 40, 50 unit building. They would come in at some sort of discounted level, purchase some of that equity, and now they have a completely passive investment in an income generating building. The number one benefit they have is that building has some sort of rent coming in. Because of that rent, and minus the expenses, obviously has a net operating income. That net operating income is going directly to the investor. So that's an immediate gain. The other gain we're seeing is tax benefits. So a lot of the guys we work with are real estate professionals. Being a real estate professional or having some sort of previous gain, they're able to take a negative K1 against that asset. So we'll do a cost segregation, especially on the assets that come online in this calendar year. The other big benefit that investors are getting is they own something tangible, right? They could look at that building and say, hey, I own that building. I'm a 20%, 50%, 30% partner, whatever it may be on that actual asset. They could see it appreciate over time and really peg performance on that one asset. So the thinking behind, grouping properties up and doing multi-family, multi-asset syndications rather than, going per deal was very simple. Earlier in the year, January 2023, we did a lot of single deal, multi-family assets where we would have investors come in and they would buy a certain percentage of the equity on, a single asset. As we were putting these online, we were filling them up with investors like almost fighting for properties. So what we decided to do is group a lot of these properties up together. And what that allowed us to do was when you go to lenders, it gives us more leverage to get better terms with the lender. It also allowed faster closings and cheaper closing costs. So the overall exit strategy is actually, one, taking advantage of the interest rate environment of 2023. And two, taking advantage of the rental increases we've seen in the last 2 to 4 years. When you take an asset we're buying in at with some sort of discount today, and you're seeing that the interest rates are a little higher today than they should be or than they were 2 years ago, we're going to developers purchasing these assets at a discounted value. So right away from day one, we're buying into these assets at a discounted value, typically 80 to 90% of the value of what they're worth, right? So doing that allows our investors to get in cheap today. As rents increase over the next 1 to 3 years, which we're seeing, and I'm saying even just a 2 to 3% increase, and as rates kind of drop a little, which would increase our loan to value, and you put all of these numbers together, in that 2 to 4 year hold time that we're in, we should see a huge increase in the value of the asset. Our investors are seeing 20 to 30% IRR and still retaining ownership of that asset. Meanwhile, in that time period, they're also getting some sort of dividend on their money, typically about 8%. So they're making an 8% return. They're getting refinance proceeds in 2 to 4 years, which is tax-free, and they still hold ownership of these assets with no management involved. So in 2023, we've had pretty much the same structure on our evergreen funds. We currently have 3 evergreen funds that we operate. One of them is a debt fund and 2 are the equity funds. Pretty much the same thing we've done in 2023 as we did in 2022. And probably in 2024, we will introduce another fund, but it'll be very similar, and that's just because of a fund being maxed out for various different reasons. The funds are still doing great. They're still a very good way for investors to get cash flow in on a monthly or quarterly basis, or on the LP side of funds, it's also great because they share in the upside of our performance. The shift we've seen in 23 from previous years, a lot of investors would come in and they wanted to make high cash on cash return, get paid every month or quarter. That's still there. We have a lot of investors who love that product. As the investors have also been growing with us, a lot of them have been adding or shifting capital to more equity geared investments. So we're seeing people that want to own real estate. A lot of clients also want to be part of a project. So we're seeing that our syndications on ground up developments are getting filled up rather quickly because they want to be able to own and be part of a new construction building that's going to last. Most of our investors, they come in on most of our products. So one investor isn't just, all right, I'm an investor in this ground up. No, they're gonna come in on a ground up, they'll put some money in the fund, and they'll diversify within the options that we provide them. That's what we've been seeing over the last few years. This year in particular, in 2023, we've seen a lot of interest with existing investors coming into one of our standalone syndications deals, be it multifamily or be it a ground up development. So we've seen a lot of that, and we're thankful for that, truly. I ask all of our investors and potential investors to come into Veloce Capital, reach out to one of us. We can do a site tour, we can go into the field and see how we deliver more ways to invest.